Hi. Let's learn about securities offerings. An issue is a process of offering securities in order to raise funds from investors. Companies may issue bonds or stocks to investors as a method of financing the business. The term issue also refers to a series of stocks or bonds that have been offered to the public and typically relates to the set of instruments that were released under one offering. The issuance of securities can take many forms. Companies may have a new issue, in which they release a security for the first time, or a seasoned issue, in which an established firm offers additional shares. In general, an issue tends to refer to a particular offering. If a company needs capital, among its options are selling stocks or issuing bonds. In a secondary offering, the board of directors votes to issue more shares and increase the number of shares available in the market for trading. The proceeds from selling additional shares to the public go directly to the company. Likewise, if a business wants to move existing debt and create new debt at the same time, it might decide to issue bonds. The company borrows money from investors and repays it with interest. The interest is a tax-deductible expense that reduces the corporation's cost of borrowing. Companies need to consider business goals when deciding whether to sell stock or to issue bonds. Issuing stocks or bonds in order to raise capital for projects can have the effect of changing the capital structure of a firm. How weighted a company's structure is in either debt or capital determines the cost of capital for the company. The cost of issuing debt is the interest rate that the issuing company has to periodically pay its investors and lenders. The cost of issuing equity is dividend payments. Finding a good balance between both types of securities can help a firm avoid paying a high cost of capital. Companies issuing stocks and bonds may use investment banks to facilitate the process. For example, if a company decides to sell bonds, the investment bank determines the value and riskiness of the corporation, then determines the prices, and finally underwrites and sells the bonds to the public or privately in a so-called private placement. Investment banks might also underwrite stocks or other securities for an initial public offering or secondary public offering. Underwriting involves conducting thorough research and assessing the degree of risk associated with a new issue. Here are 3 key takeaways. 1. An issue is an offering of new securities to investors in an effort to raise capital. 2. Issues of bonds can be made as long as there is investor appetite for the company's debt. That appetite is influenced by the company's ability to make bond payments. 3. Additional issues of shares of stock lead to dilution, which may push down stock prices. Hope this would help. Thanks for watching.